There is a specific dollar amount you need to memorise today. $21,884. In Australia, if you are a single senior eligible for the Seniors and Pensioners Tax Offset, that is roughly your tax-free threshold. If you draw a part pension and have any other income at all, including interest from your savings account, every single dollar above that line is immediately taxable. That is where we stand in 2026, and the trap is closing fast. Every year, inflation pushes incomes up, but the tax-free thresholds barely move. This is a silent, deliberate trick called bracket creep. The Australian Taxation Office does not write you a letter to warn you about it. Your local bank manager certainly will not warn you either. The window to protect your cash before the end of the financial year closes on June 30.
I have spent years looking at the finances of everyday Aussies who have worked hard, paid off their homes and put a bit of cash away for a rainy day. And I keep seeing the exact same disaster over and over again. Lazy bank accounts generating massive tax bills that catch retirees completely by surprise. Not because they did anything wrong, but because the government deliberately hides the rules. Today, I am going to show you exactly how the ATO is quietly taxing your bank savings and the single, entirely legal move you must make before July 1 to stop the bleeding.
We need to clear up a massive misunderstanding right now. Millions of older Australians assume that because they are retired and because they no longer receive a wage from an employer, they are invisible to the taxman. They assume the money sitting in their Commonwealth or Westpac savings account is safe. It is not. In 2026, every single bank and credit union in Australia reports the exact amount of interest they pay you directly to the ATO. It is completely automatic. The ATO's data matching computers link that interest straight to your tax file number.
Let us put some brutal math to this. Because interest rates have risen, a standard high-yield savings account or term deposit pays around 4.5%. If you are a conservative retiree with $50,000 sitting in the bank for emergencies, you earn roughly $2,250 a year in interest. If you have $100,000 parked in the bank, you earn $4,500. Most people see that interest land in their account and think they are winning. But if your total income, including your super withdrawals, any part-time work or rental income, pushes you over that tax-free threshold, the ATO wants their cut. If you sit in the 30% tax bracket, the ATO takes $1,350 out of that $4,500 interest. They take it quietly. When you lodge your tax return or when the ATO calculates your assessment, that money's gone. You are bleeding cash to the government purely because your money's parked in the wrong environment.
Let me tell you about a real scenario that happens constantly. Let's call her Shirley. Shirley is 71, widowed, and spent 40 years working as a nurse. She sold an old investment property and parked $150,000 in a standard term deposit because she wanted it to be safe. Shirley receives a part-age pension. She had not paid an income tax bill in over 5 years. She assumed her money was fine. Then she got a letter from the ATO demanding thousands of dollars in unpaid taxes. Shirley thought it was a scam. It was not. At 4.5%, her $150,000 term deposit generated $6,750 in interest. The bank reported it, the ATO added it to her other income, pushed her over the tax threshold and slapped her with a bill.
She had done absolutely nothing wrong. She had just never been taught the rules. The government happily let her pay tax on money she was trying to preserve for her aged care. When interest rates were sitting at 0% a few years ago, nobody noticed this trap because bank accounts paid nothing. Now that rates are up, the ATO is issuing thousands of tax bills to retirees who never saw it coming. The interest rates changed, the tax bills followed. Here is the part that should make you angry, because the solution is incredibly simple and the banks refuse to tell you about it. You do not have to leave your money in a taxable bank environment. You already have access to the greatest legal tax shelter in the country. It is your superannuation.
If you are over age 60 and completely retired, you are legally allowed to move your superannuation from the accumulation phase into the account-based pension phase. When your money sits inside that pension phase, the Australian government taxes your investment earnings at exactly 0%. Let us run Shirley's math again. If Shirley takes that $150,000 out of her term deposit and transfers it into a superannuation pension account as a non-concessional contribution, she completely changes her financial reality. If the super fund earns that exact same $6,750 in interest or dividends, the tax rate is 0. The ATO gets absolutely nothing. Shirley keeps every single cent. On top of that, any cash she withdraws from that super pension to pay her grocery bills is also 100% tax-free.
Two identical households, same amount of savings, same amount of income. One leaves their cash in the bank and gets a massive tax bill in the mail. The other puts their cash into the super pension environment and pays 0 tax permanently. The only difference is an afternoon of paperwork. This brings us to the most urgent part of the entire strategy. You can't just dump $500,000 into your super account whenever you feel like it. The government sets strict rules and the clock resets every year on June 30. In 2026, the standard non-concessional contribution cap, which is the after-tax cash you move from your bank account into your super, is $120,000 per year.
If you have $100,000 sitting in a lazy bank account right now, you have until June 30 to physically transfer that money into your super fund. If the money clears the account before the deadline, you have successfully sheltered it from the ATO for the next financial year. If you have more than $120,000, you can use something called the Bring Forward Rule. This allows you to combine 3 years of limits into one massive deposit. In 2026, you can legally dump up to $360,000 of your bank savings directly into your super in a single day. But if you wait until July 1 to start thinking about this, you have lost this year's window. You will sit through another 12 months of your bank interest being eaten by the ATO. The government relies on your procrastination. Every day you delay is another dollar for their budget.
When I explain this math to blokes, their first reaction is always the same. But Bruce, I need that money in the bank for an emergency. I can't lock it away in super. This is a massive myth. If you are over 60 and have met a condition of release, your super is not locked away. It is your money. If you move your cash into an account-based pension, you can withdraw it whenever you want. If the roof caves in tomorrow, you simply log into your super app, request a withdrawal, and the cash is in your bank account in a few days.
You should absolutely keep a small cash buffer in your normal bank account, maybe 3 to 6 months of living expenses, just to cover the everyday bills. But hoarding $50,000, $100,000 or $200,000 in a standard bank account out of fear is financial suicide. You are paying a massive premium to the ATO simply for the psychological comfort of looking at a number on your banking app. Your money is just as accessible inside the super pension phase, but it grows in a zero tax vacuum. The Australian tax system documents itself perfectly. You can find all these rules on the ATO website if you want to read hundreds of pages of legal jargon, but the system never actually explains itself to the people it affects the most.
The people who pay the highest price for this silence are the ones who did everything right. They saved carefully, they kept their money safe in the bank, and they never asked the government for a handout. The ATO rewards that discipline with a tax bill. You have until June 30 to fix this. The most valuable single action you can take this week is to look at your bank balances. Calculate how much interest you are earning. Check your marginal tax rate. Then call your super fund and ask them how to make a non-concessional contribution before the end of financial year. If you are part of a couple, you both have these contribution limits. You can move massive amounts of money out of the taxable system if you operate together.
Do not let the government quietly drain the wealth you spent 40 years building. Your bank is not your friend. The ATO is not your partner. You must be strategic. Move the lazy cash out of the bank. Shelter it inside your super pension phase. Legally drop your tax bill to zero. The people who survive retirement are not the ones who earn the most money. They are the ones who know exactly where to put it. If this video saved you from making a massive mistake before June 30, hit the like button so the algorithm pushes it to other Aussies who are hoarding cash. Drop a comment below and let me know if the ATO has ever hit you with a surprise tax bill on your bank interest. If you want to support an independent bloke keeping the politicians honest, click the join button below and become a member of a channel. I'm the Retired Aussie, and I will see you in the next one.